The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
Well, so we do these on a periodic basis, and let's say once in a while, once a couple of times a week, we think of what should we do today? And so we create this podcast. It's kind of a short term of what we're going to talk about today, the investment theme of the day, or
There we go.
It was online, it's called the investment theme du jour. It's what are you serving up today? What's Wall Street have in store for you today? You have a little bit of investor fear. Maybe it's real fear about the market's overextended, or you have FOMO, fear of missing out because you've been out of the market and you just watched it go up and you're not participating, and now you're ready to pull your hair out. Unless you're our age and you're just, you relish keeping what you have.
It's too precious. You can't pull that out. That's right. You got to leave that alone. Yeah. So,
but the problem is that we have a very, very concentrated market, and it's been that way. Well, at least since COVID. Wasn't as bad prior to COVID, but we basically have a market that was referred to as the Magnificent Seven. Now we're down to the Fabulous Five. You have 5 stocks driving the market indexes, and most every place else you look, you're dragging an anchor. You're not going anywhere, and that's a problem for investors. So why don't you summarize what we were talking about before we started the recording?
we're talking about what this market is right now. What are we looking at right now? And there was a few Wall Street traders sitting around and talking about what's going on in the market right now and what's going on. And their consensus was this market's going up because the market wants to go up. And their line of thinking was, don't overthink it. Don't fight with the market. If it's going up, let it go up. And right away they conceded, talking about the market as if it's a person is not a very sophisticated analysis of what's going on, but that's what's going on right now.
Because Warren Buffett refers to it as Mr. Market.
Mr. Market, that's right. You can always take a look at, and in essence, that just means in total, what are most people thinking about right now? And right now, most people are thinking it's a market you can't just walk away from. Things are going up, and the biggest shadow hanging over the market right now is an overheating American economy. The reason the Fed mostly is saying we're going to have higher rates for longer is because they can't get the economy to slow down. Everything just keeps cranking up. That's bad for inflation. And so the Fed's worried about not being able to do their job, letting things get out of hand. So they're going to keep rates high. We don't think they're going to raise them because it's too expensive to afford what's going on to finance the ongoing government debt. So it's probably going to stay where it is. But the cuts aren't going to come as quickly as we thought. And the market as a whole is starting to get used to the idea. And so now it's just a matter of, okay, so this really is a mostly purely momentum-driven market. It's going up because it's going up. It's going up because people are buying. And most fund managers seem to have their finger poised over the buy button most of the time. And no one's running for the exits yet. It's just important to remember that a market that's driven primarily by momentum and FOMO, just the fear of missing out. I'm going to be in this because I can't afford to be out of it. They tend to be a little more fragile. And when they turn, they can turn quickly. So you can't go to sleep on this. But right now, the bottom line is this market's going up, and it's going up because people are buying. And right now, you don't need to really overthink it much more than that. You need to be participating in the upside of what's going on right now. You're going to have days like today. Tech sector is getting hit today. but that should be expected because it's been so profitable and things have been moving up so rapidly with mostly circling the new AI offerings and the new AI services being offered by everyone and promoted by everyone. Maybe got a little over the skis there, maybe got a little ahead of itself, so a little correction today. But there's probably nothing wrong with it, and there's probably nothing wrong with staying attached to this market. It's just not a market you can go to sleep on. You need to be paying attention all the time right now.
Well, and that really points out, or we need to point out that the fact that the indexes have been going up is not representative of what has actually been happening in the market. In this
Correct.
case, what we have, this is the Russell 2000, and this goes I went all the way back to 2020, and you can see that what we're going through is a whole lot of uncertainty and a whole bunch of chop, rally, fail,
Yep.
rally, fail, rally, fail, rally, fail, really fail. Oops, well, that's not that bad. Rally, fail, rally. It's not that good. Fail again. Not that good. Fail again. And so if you've basically been in here and since the fourth quarter of 2020, and if you're a buy and hold investor, you haven't gone anywhere. And these smaller companies are actually the companies that generate most of the employment in the country. They
Sure.
are absolutely essential for economic growth. And the ones that trade publicly, that's where we get the accounting of what's actually happening with the larger number of small companies that don't trade publicly, privately held. They're basically struggling. And so if you are diversifying your risk by owning lots of different asset classes and lots of different stocks, you're really struggling trying to figure out what on earth do I do? I must be doing something wrong. No, you're not doing something wrong, except that the market is dynamic. And right now, the magnet for money is in momentum, and that's being driven by hopes for outstanding performance from the production or the application of AI, either within the company or as a product to service other companies who need the AI enhancement. And if you're not there and you're not concentrated, you're going to be struggling with great disappointment to keep up with the market. This is a year where the market returns distort reality for investor risk management. And it's hard as a
Correct.
professional. You know, I do webinars with professionals 2, 3 times a week. And dealing with this concentration is an extremely difficult issue. One, to explain to clients, and two, to manage through compliance departments if your financial advisor is with a major firm, because they basically say diversification. Be in small cap stocks because that's where the value is. That's what's on the screen. Or we turn around and take a look at, let's say, bonds. Well, that's not bonds, that's Tesla. Let's take TLT. And this goes back to the high, well, we run it back here, the high of 2020. This is your bond portfolio. That's part of your diversification. Well, that's not working either. Now, what do you do? Well, one of the things that Wall Street is really good at is when things aren't working for investors, they create new product. If you don't like this one, I have this one. How does this sound? So you don't want to be in stocks. You don't like paying taxes on the dividends. We'll put you in an annuity. You don't like that because it ties up your money. How about we guarantee you buy into the S&P 500 and we guarantee in 1 year you won't lose money. In fact, we'll guarantee you're going to get 5%. Or maybe that's not enough, you want 8.
Correct.
And so you say, okay, I'm not going to lose money and I'm going to get a return that's close to historic averages. Sounds like a deal.
But and that deal, Don, that is so important for everyone to really get your head around that these investment themes, the theme of the day that Wall Street is promoting, 90% of the time, it's just a sales pitch. It's because there's a product coming behind it that says, hey, the Magnificent Seven is all there is. That's what you have to do. Hey, we've got a fund for that. You should buy this product from us. Or go back. Remember when everybody, you had to own the bricks? Everybody's got to own the bricks. And they invent that stuff just to sell you something. It doesn't mean it's a good idea. It means that, hey, this is a really catchy promotion we can run and we can sell everybody this. And if enough people buy it, it might actually make some money for a while. And if it doesn't, well, then we're going to invent another one. And it's important not to get your investing mixed up between the sales pitch of Wall Street and the reality of what you can look at, track any data in the market and follow that, follow the data. That's much more likely to keep you on the good side of a trade more often. Even that doesn't work all the time, of course, but you're going to be right more often tracking data than listening to a Wall Street sales pitch about what's the investing theme today and what is it that you can't afford to miss. That's always attached to something they're trying to sell you, and it's just a sales pitch. And never forget that.
Well, that's right. So the ones with the guarantee, basically, you have to ask, well, how do they do that for me? And one 1 year out, they're going to buy a treasury bond that guarantees that they're going to have the money to pay you back. So they have no downside risk. Their risk is if the market's up more than what they offered as a cap, presumably the market's up that much and more, and they get all the extra upside and they can hedge themselves against the loss of the money. But as far as you as an individual investors, as Matt Levine says in the Bloomberg daily issue that he puts out, he says, this is really stupid for an investment. Don't buy it. You can do what they do by buying a 1 year treasury. And that's your issue. But the thematic investing sells. People get that concept in their mind that says, now that really sounds good. The green energy deal. We had years ago, a few years back, green energy, ETFs and mutual funds, they were the thing. And we ended up with a big press from BlackRock, Larry Fink at BlackRock, going to corporations and say, if you don't invest according to our green energy policies, we are going to sell your stock. And force CEOs to do things that were not in the best interest of the shareholders. Well, that's come back to bite Larry Fink in the backside, and he's had to back off of that because companies got sued for not doing their fiduciary responsibility to take care of shareholders first. Government policy for something that is still in debate isn't in the shareholders' best interest. And Larry Fink and BlackRock have had to back off the force green energy down everybody's throat. That theme and the collapse of many of the prices of stocks that were related to making that theme work have suffered. So one of the ETFs that, well, there's been several that closed. If they don't get enough business, the ETF will be closed down, and whatever money they have left in the shares, that's going to go back to you if you're in it. But so when you're looking at these themes that seem attractive, you need to actually look and see what kind of volume there is in the underlying stocks in an exchange traded fund to see if there's enough justification for that fund to make money to survive its operating costs. If not, that thematic bet is not going to work out at some point in time. And the one that comes to mind most recently is KOL. What's a coal fund? Coal was part of that green energy. It's going to go out of business, and investors left it in the lurch, and they closed it down. Within less than a year, coal prices started rising. Then if they had held on 6 months, that would have turned into a reasonable, attractive investment alternative that was commodity related as commodities began to rise in price.
Reality always kicks in. It always kicks in eventually, and the theme that they're promoting will evaporate, and it's actually supposed to. It's supposed to evaporate so they can build another one and sell you something else. So just remember, right now we're kind of locked down between. We've got a great large cap tech sector rally going on right now. We've got a market that wants to go up, balanced to get against a Fed that's trying to get inflation under control. You don't have to make a bet and say, here's what I think is going to happen. You can wait, you can watch the data, and you can say, if this market continues up, I'm staying in. And that's what we're doing. You watch that data as it comes in, and you can think about what you think the Fed's going to do, but wait until they actually do something before you make a decision. You don't have to guess. You can track the data, you can track the trend, and follow the money. And that's the best way we found to work a market, especially one that is a momentum market like the one we're in.
Well, you mentioned inflation and the Fed trying to deal with it. The Fed didn't cause this inflation, so he's not going to be able
Correct.
to unwind it. But neither
Yep.
the Fed, Chair Powell, or Treasury, um, Janet Yellen, neither one of them have had the personal conviction and strength in their congressional testimony to tell Congress, quit spending money. That's our
Right.
problem. You're
There
spending
we
money
go.
and we don't have any way to fund it. We have to go to markets, and you're putting more money in the system without building anything. You're giving freebies out to people who haven't produced anything. That's inflationary. Stop it. And neither one of them have been able to draw that line, probably because they want to keep their existing jobs as long as possible instead of dealing with the
There we
truth.
go.
I mean, it's
Yep.
kind of like dealing with your teenager. When your teenager wrecks the car and you say, you don't do that kind of driving anymore, or you're going to lose your license. No, I don't want to lose my license. And the kid quits doing squirrelies on the parking lot. You know, that's the kind of lesson that needs to be addressed in Congress instead of accepting their pablum that they dish out during pre-election commentaries. We need somebody there who actually says, we have to balance this budget. It may take time, but we have to get there. And if we start doing responsible things with our money, inflation can come back. But as of now, the current assumption on Wall Street bond traders is that inflation, or the core rate that the Fed is looking at, is no longer 2.75. The market trader thinks it's 3.6%, and that's going to last for several years. So looking for lower interest rates anytime soon is apparently a fool's game, because professional bond traders just don't see it happening. Anyway, you got to look underneath the hood, figure out what you're actually doing instead of buying the storyline that maybe look tempting and exciting, but it's the fundamentals that eventually drive everything. It's a dynamic market. It changes constantly. Somebody has to pay attention, make a decision, and act on it. If you need help doing that, that's one of the things we do. That is what we do with managing our portfolios. Give us a call, log onto our website, send them a message, an email, help@iriradio.com. Thanks for being with us. We'll be back with another session.